Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. As always, standard disclaimer before we get started, nothing here is investment advice. Do your own due diligence. We bring you the information, you do your own research. And we've got a returning guest today, an economist who specializes in gold, money, and credit, and the founder and CEO of Monetary Metals. It's Keith Weiner. Great to have you back on the show.
Thanks for having me, Jesse.
Yes, excited to have you back on. Very interesting day in the markets as we're recording right now. It is August 2nd. This interview will be released a little bit later, but from your perspective, we were just chatting before hitting record. Everything seems to be selling off. Gold seems to be one of the few things holding up right now, and US Treasuries are actually appreciating in value. What are your thoughts on the action we're seeing right now? Is this the beginning of the big crash everybody's always talking about, the big correction in the broad market?
You know, if I knew that, just to be slightly snarky about it, I wouldn't be on this interview. I'd be trading and making trillions in the markets. Um, as Yogi Berra said, predictions are hard, especially about the future. Um, but so I can't tell you if this is the big crash or if this is a one day, noise in the correction, and tomorrow the market's going. I don't know that. What I do know is that other central banks in the world have begun cutting interest rates, and it's obvious the Fed is going to cut interest rates, and not because they want to. I mean, they are trying to maintain the pretense, as they've done for 40 years, of falling interest rates. They're trying to make the pretense that, it's just this little crisis, just this little blip, just this little market, glitch, and then we'll get interest rates back to normal. It's a steady downslope for 40 years. Where along this slope would you point to and say is the normal point? It's there's no reversion to mean. It's just sliding and sliding. And I've written an enormous volume of articles and words about this, and why the interest rate is falling, and it's secular, and it's durable, and it's pathological, and that's how the system comes to an end in the end. Is by we're drowning in falling interest rates, and post COVID, everyone said inflation, and they said exponentially rising quantity of money, and that's going to mean the dollar is going to have to sell off. We're going to have massive inflation, and the treasury bond is going to have to sell off. And the first thing I point out is that there is no actual real way to hold dollars and not finance treasury bonds at the end of the day, right? So either you hold a dollar bill says right on it, Federal Reserve note. So you're giving the Fed credit, and the Fed uses that credit to buy treasury bonds. So you're financing the treasury bond one for one with every dollar bill you hold. Or you could buy treasuries directly. There's treasurydirect.gov.com or whatever it is. Or you can buy it in most brokerage accounts. Or thirdly, you can put a deposit in a bank. And what is the bank going to do? By statute and by business models, they're going to buy treasury bonds. There really isn't any way to separate the two. The idea that people think there's inflation, interest rates have to go up, it just isn't true. It just doesn't. The system just isn't wired that way. And I like to use the example of suppose you're watching a Formula One race, and you have an Xbox video game, and you have a toy steering wheel and gas and brake pedal controller, and you see that driver is headed into a curve, and you think he's headed too fast, and you want to tap the brake on your Xbox controller. It isn't wired to his car. No matter what you do on your toy, right, it's not going to affect the real car. And anyways, I've been saying, look, interest rates are going to resume their falling trend. Everyone's like, Keith, you're nuts. Inflation, look at how much the money they're printing. And I was like, if an increase in the quantity of dollars, which you call printing, I won't quibble about that right now. If an increase, especially an exponential increase, caused interest rates to rise, then we would have had rising interest rates post 1981, because certainly the quantity of what we call money was rising exponentially all during this time. But it's not true. It just simply isn't. So we're now at that point where the Fed And they don't really want to. They really want to prove that, yeah, we're independent and we're doing the right thing. Monetary policy is bi-directional; it goes up as well as down. They really want to prove this point, and I think they have something to prove because if you look at the facts, it's pretty clear it's the opposite. Um, but as things get worse in the parts of the economy they care about, then they're forced to lower rates, and so you get kind of a weird dichotomy where if you just look at what I think should be econ or finance 101, net present value, right? If you add up a bunch of cash, payments that extend into the future, each one of those payments has to be discounted to the present. You add up the sum of those, that's the net present value. And the discounting factor is the market rate of interest. That's my argument. I guess other people may use a different discounting factor, but it is certainly a simple function of the math that the lower the discounting factor, the lower the interest rate, the more that all those payments in the distant future are worth in the present, right? So if the interest rate was zero, if the discounting factor was zero, then a payment to be made 20 years from today is worth the same today as it would be in 20 years, which is the contradiction of monetary policy anyway. But so asset prices, ceteris paribus, economists love to say that. It's a term meaning all else being equal. If the interest rate falls, then asset prices should rise. But a lot of people point out that when the interest rate falls, asset prices fall, not rise, and they think the theory is wrong. But actually, there's a simple answer to that, which is no, the theory is right, but there's a reason why the Fed is cutting the interest rate. And that's the reason why asset prices are going to fall, which is there's real stress in credit land out there. By hiking interest rates so high, the government has starved the private market for credit that it so desperately craves. And, that first hits the margin, and then it hits much bigger companies. Intel just announced they're laying off 10% of the workforce are going to be gone in a couple of months. And so, people look at unemployment, which is a lagging indicator. What's the thing that leads it is credit. And so it's not necessarily Intel's access to credit, it's Intel's customers' access to credit, driving this probably. I mean, I'm not an analyst of Intel stock per se. So you get some very funky things going on in the economy. I don't think, and I'm very much public on the record, I don't think the Fed cares whether you have a job or not. This idea they care about unemployment is, let's just say that's the given reason, for a lot of their behaviors. And then I don't think they really care if consumer prices are going up either, other than that maybe that creates some political pressure to lean on them to do something about it, whatever that means. But I do think they care a great deal about the balance sheets, the solvency of the banks, especially the big crony banks, which are the members of the Federal Reserve. And so if they see credit defaults starting to cascade through, the economy, then, that's trouble. And that's why they, try to, slam interest rates down. And usually they're, not necessarily too little too late, but usually they're too late. And by the time they're reacting, it's already baked in the cake. Imagine a consumer who, owns a house and has some credit cards and whatever, and is getting deeper and deeper into trouble. And, let's say he's 90 days past due on the mortgage. The credit card companies are threatening to turn the cards off, and, the mobile phone companies threatening to turn on, and then the Fed lowers the interest rate to zero. Well, chances are this hapless homeowner is probably too deep. It's not going to fix his problem anymore. And so then a whole bunch of things have to fall over. And then you get a new stimulative wave, which people think is the business cycle. It's a complete misunderstanding, but you get a whole new wave. Eventually that interest rate at zero is extremely stimulative. And then the next round, happens all over again. Anyways, I was kind of rambling a little bit, but I'm trying to make a couple of points, which is interest rates have to keep going down. There is very little private demand for credit, except on a downtick in the interest rates, which is why the interest rate keeps falling. And so here we are on a day where everything is falling, gold holding up, because gold kind of has this duality. On the one hand, if times are good, people have more money, maybe they want to buy more gold. Certainly in other parts of the world, that's how it works. But if interest rates are going to slam back down, then people think, oh, that's inflationary, and I'm going to buy gold as a hedge. So you get people buying gold kind of on either side of the trade. Meanwhile, I think we're in a bull market anyways for a lot of other secular reasons. And so all that hits. And, today's kind of a mixed day. I mean, earlier in the day, I'm in London, so I get to look at the market like, way before the New York Open. And, price of gold was up, I think 1.8% or 1.9% or something. And, the last time I looked an hour and a half ago, it was nowhere near that, but I think it was still green. I don't think it turned red. So make of that what you will.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Well, let's hone in on gold here, because last time I had you on the show back in March, you said gold was in a stealth bull market, and that the price was around $2,200 at that time. Now we're sitting close to the $2,500 mark. This gold bull market seems to be more apparent, but I still don't see the mainstream financial press talking about it. I think your average investor in the West still is not interested in gold, has very little understanding of it. What needs to happen here for gold to finally get some respect in terms of attention from the broad market, from the talking heads on CNBC, etc.? What does it have to hit 3,000?
So I'm chuckling because obviously both time and price is going to get the attention of everybody who's in it for a trade. And of course, that's exactly how the price gets ahead of itself, right? Which happened in 2011 is, okay, it's obvious, the case for gold is obvious, the bull market is obvious, and more people pile in and, trading on the story that was kind of last year's story, not realizing that, okay, it's getting overextended. And in fact, all that money, chasing it is the reason that was pushing it overextended. And then eventually, you get the correction and the reversal, which I don't think we're anywhere near right now. So, obviously higher price. I mean, I couldn't tell you what the magic number is, whether it's 3,000 or 2,750 or whatever, but there'll be a price at which, they can't help but talk about it. And, I frame it that way because the mainstream obviously it's obvious to me anyway. And I think most people that watch, your show probably would say it's obvious that they have an aversion in the mainstream to gold. It's a 4-letter word. They just don't like it. And if you say gold in polite company, you're like outside the Overton window. Everyone's like, ew, who let you in here? You're one of those. And, so they'll talk about it if they're forced to, but they don't like it. For all the reasons of everything that gold stands for. And, so they'll talk about the gold bull market, of course, especially if there's eyeballs that are, turn into ad revenue. But reluctantly and probably belatedly, grudgingly, and then, as soon as they can, oh yeah, is this the top? There'll be a lot of stories. This the top. And that's the bull market's climb, a wall of worry, right? I don't know if that goes back to Jesse Livermore, who was the origin of that quote, but, that's exactly what it is. And of course, it isn't really a bull market in gold. It's a bear market in the dollar. It's the quality of this thing we call dollar. It's just, declining. It's it's a punching bag that everybody's, especially the U.S. government is abusing. And, so that doesn't necessarily manifest in consumer prices, which are driven more by interest rates. But people do think of gold as, a way of opting out of the game a little bit. And, now to put in a plug for my own product, I think the thing that ultimately makes gold, you said, what would make it respectable is when it earns a proper yield. And it's a proper financial asset. It's not something, most people don't really want to bet on a lump of metal, as Warren Buffett would put it, that its price is going to go up. Even if its price is going up, most people don't really psychologically want to make that bet that way. But if it's something that earns a return, whole different story.
Yeah, we'll get into that, what monetary metals offers in terms of getting yield on both gold and silver a little bit later. I do want to touch on silver right now, a metal that seems to kind of languish, but that always has these big price predictions assigned to it. People like Don Durrett and Chen Lin have been calling for $50 silver this year. I recently had David Hunter on the show. He said silver is going to get to $75 this year. As you mentioned, making predictions is not exactly something that generally turns out well. So I'm certainly not asking you for a price prediction, but I do wonder how you see things playing out for silver from here, because gold breaking to all-time highs, sitting around the 2,500, 24 to 2,500 recently. Silver still kind of languishing around the 27, 28. It broke 30 for a little while, came back down. What are your thoughts?
I was one of the voices that was, naysaying all those predictions for, a decade post, the big high and the crash in 2011. And every time the price would blip, they'd say rocket launch, and they show pictures of, rockets to the moon and all that. And it's just not going to happen. Look at the data, look at what's going on. Like, this is going to reverse itself. It's going to end in tears. And from 2012 to 2018, it always did. And they hated me and they called me perma-bear and all that. We have a model. I think I said the last time I was on your show, Charles Box has a famous saying, and certainly in data science, machine learning circles, all models are wrong, some models are useful. So we have a model, and that said, that tries to figure out what the price would be if you back out the action of the leveraged speculators in the futures market. And our model is currently saying about 31 and a half for silver. So it's significantly above the market. And, whether the price of silver hits 31 and a half, tomorrow or Monday or next week or whatever, isn't the point. The point is there's a tension, that wants the price to go higher. And so most likely, continue in that bull market. It's interesting that, the price of gold's an all-time high, and the price of silver is, 40% off the price that it was in 1980. There's a world of difference between the two. So I'll just share one anecdote. So we have a silver bond right now to finance a silver producer. It's called Bunker Hill Mine, paying 12% net to investors. And the point of this isn't to plug that, although that is open and anybody who wants to return on their silver can contact us. But so we're talking to, a good client of ours, a pretty large investor, who's very, savvy about mining, and he's very interested in gold mining deals, and he's participated in our gold mining deals. And I asked him, okay, what do you think of the silver deal? And he said, yeah, I think it's a good company. I know some of the people. He said, no interest in silver whatsoever. And I was just kind of like, raise the eyebrow, oh. And he said, those, beep, beep, been predicting silver is going to be, $50, $100 since forever. It's never happened, not going to happen. I'm just not interested in silver as an asset class. I'm sure the bond is fine. I'm sure the mine is okay. I just don't believe in silver as an asset class. Too many broken promises, too much money lost. I'm done with silver. And, is he typical? Fortunately not. We certainly have many, many investors that are interested in the bond. But it just goes to show you kind of the sentiment around it. Silver has a much bigger wall with a lot more worry sticking to it than gold does.
Yeah, and it's funny because there's people who will literally call themselves silver stackers, and they put most of their money into physical silver, and they develop this weird emotional connection to the silver, and they hold it for a decade plus, and then they start to bemoan their fate when they just keep dollar cost averaging or whatever into this big stack of silver in their basement, and then they start to get very upset when the price does not go up to these, targets that people are putting out there. I want to talk about political and geopolitical chaos that seems to be a major theme so far this year. We saw a presidential candidate nearly get assassinated, the other one dropping out of the race. Wars in Ukraine and the Middle East continue to escalate. Civil unrest in Bangladesh and Venezuela, a civil war in Sudan, still civil war in Myanmar. I mean, the list goes on and on. Now, I know a big part of this all coming to light is just the fact that we live in an era of social media where everybody's got cameras now. So, news spreads instantly. You get to see videos of cities getting bombed right away. So, I don't know that now is any crazier than at other points in history, or if it's just how much these sorts of news items spread over the internet and over social media, and all these different people with agendas, pushing them out there and making everything really hyperbolic. Nonetheless, I wonder what your thoughts are from a geopolitical and political realm, and how much all of that has an impact on both the markets in general and precious metals markets in particular, if at all, or is it all just noise? People should block it out.
I mean, there's a big caveat I have to give here, which is analyzing geopolitical events and geopolitical risk is definitely pretty far outside my personal swim lane, and I'm not necessarily an expert on it. I would tend to say, like, if you're talking about civil war in a place like Sudan or Myanmar, I would dismiss that as noise, because there's always civil war in Sudan, and those are just bad places that eventually, hopefully, the Enlightenment will reach their borders. But you know, Bangladesh, I don't know if they've had that kind of civil unrest, a long while. Venezuela, okay, that's another one. It's socialism starts out with the assumption that in capitalism, there's a built-in conflict of interest between classes, and that history is class struggles, which means war. And then socialism proceeds to create the very conflicts that it pretends to be the cure to. And because the government takes over all the resources, you starve if you don't curry favor from the government, and then all the other interest groups are carrying the same favor. And of course, socialism is destroying all the resources. So it's a not even a zero sum pie, but it's a negative sum pie, and everyone is fighting with everyone else. And so it eventually has to collapse into open war in the streets, assuming they don't abolish it peacefully. And of course, usually the socialist dictator, the last thing he wants to do is give up power peacefully. So in a certain sense, I'd say Venezuela is not unexpected. What's worrying to me when you think about that, and you think about the U.S. and how close we might be getting to that, right now, peaceful transition of power was not the norm throughout history, and sadly isn't necessarily the norm in much of the world even today. We take it for granted in America, because we've had it since the very beginning. The first guy, George Washington, thank God, didn't accept the title of king, which they were ready to give him. He said, no, I'll be president, and accepted that he was a citizen like everyone else, and then agreed to step down when his time was done. And we might be getting close to the point where one party or the other decides the election was unfair, it was rigged, it was this or that. I'm not going to give up the power. And if that happens, it's kind of the end of the republic, kind of moment. And I don't know how close we are to that. I can't make a prediction on that. But since you asked me, I just expressed a concern about that. Now, the thing with gold, certainly, and silver, probably following along with some lag to it, is, people don't really think of what we call money as a government credit obligation, because if you allow, there's certain things, I almost kind of think of it as like, you take a cast iron skittle and you put it on, high heat on the burner until the skittle is not quite red hot, but really, really hot. And then you splash some cold water on it. You get this bead, and that bead kind of skitters off. It doesn't really it just wants to move, not even necessarily downhill, but the steam where the water is touching the iron is so ferocious, it'll push it in one direction or the other, like a propellant, I think. And I might be wrong on the physics of this. They could tell me no. You're going to have some reader who knows the physics of it. Keith is a complete idiot. This is what's really happening here. But I don't think it's because it's sloped. I think it skitters off for some other reason. But anyways, there are certain things where you can see people's minds skittering like that bead of water, off certain topics. Like they can't go there. So if you in your mind grasp, really truly grasp, and all the way to its profound implications, that dollar bill isn't money, or sorry, the dollar bill is a credit obligation of the government. When you realize that, then you kind of have to say, oh, wait a minute, that means it's not money. Like, credit is a promise to pay money. So this is credit and it's money. Like, there's a contradiction there. And so people shy away from that, and they don't necessarily think all the time or most of the time that the dollar is credit, right? But it is. And what that means is if that government is getting shakier, either fiscally, monetarily, socially, obviously internationally in terms of war, whatever, there's any number of things that can make that government less sure of being not only in power, but enjoying the current level of privilege that it has. If anything calls that into question, you don't want to be that creditor. You want to dump that credit paper. And as soon as you want to dump that credit paper, you look around the financial universe, every other kind of thing is effectively denominated in that same credit paper. I mean, even if you buy a piece of real estate in America, it's effectively denominated. No, it's not a credit derivative in one sense, but it's, as a financial asset, if you think of storing value in it and then you want to sell it, you can only sell it for dollars. This is America. If it's in the UK, you're selling it for pounds. But there's one thing that doesn't have that problem. It's gold. It's not a credit obligation. There's no counterparty that has to make good on it. And if that counterparty fails, then the gold becomes worthless. It's not how gold works. And so people turn to gold in times of uncertainty because they don't want to be creditors to an uncertain debtor or obligor. And silver follows along with for that story. And I certainly think that's true. And I certainly think all around the world, there are a lot of governments and a lot of people that would love to, reject the dollar and adopt something else. The problem is exactly what and how you're going to do that, and they're trapped. It's the perfect game theory, pseudo-stable equilibrium. Or I don't know if that's quite, I'm not an expert enough to know if that's the Nash equilibrium, but something like that. It's pseudo-stable, and everyone's trapped in it, and there isn't really, way out of it. But there's certainly a lot of people who want that way, and most of those people do buy some gold, if nothing else, as a call option on some other alternative monetary arrangement.
You're echoing a lot of thoughts that Alistair McLeod had when he was on this show, that pretty much everything is credit aside from gold and silver if you really kind of break it down to its core. And he believes that there will be a collapse of all of these credit-based instruments, fiat currency included, bonds, equities, etc. I'm wondering what your thoughts are there, and if all of the credit collapses, do you just not want to be holding any stocks in your portfolio at that point? Do you advocate for just kind of putting most of your net worth in precious metals? How do you approach that side of things?
So, yes, I do think that it all collapses in the end. And if you take that idea all the way to its conclusion, so there was a James Bond movie, I think it was the one with Max Zorin, I could be wrong, as the enemy. And, James Bond was there, I guess, sort of held captive by the villain. And they're in this building, and they had the building manager and somebody else were kind of tied up in a chair. And the villain is very casually kind of waving his pistol around. And he's like, yeah, so what happened is there was a fire, and the building manager went to pull the fire alarm, and this happened and that happened and whatever. And then because he got caught embezzling, he shot his assistant, and he shot himself, and blah, 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 blah. And it's going on. And the building owner was like, wait, but that would mean. And the villain goes, yes. And he points his gun right at him, bang, and he kills him. And, so in my mind, ever since I saw that movie, I always remember that phrase, but that would mean, credit collapse, but that would mean the collapse of everything, like the collapse of industrial scale production of energy and food. and therefore that means no electricity, which means in a city like Phoenix or LA, no water. Um, you know, even if you could still produce food, without diesel, without electricity, you're not going to produce it, and you couldn't distribute it anyway because it requires refrigeration. Like, this is a collapse of society, collapse of population, collapse of civilization. This is like horrifically, horrifically, horrifically bad. Yes, owning stocks at that point is completely useless. None of those companies will be able to, function. Um, and if you have gold, and if you're, and everyone, and in a situation like that, everyone's running. The problem is some people are running from north to south. Some people are running from south to north. Everyone's running away from what they know to be bad because they saw it and they ran away from it, running towards something else that the other people know to be bad because they're running away from that. And I picture it as something like Rome collapsing in 476 AD. The population went from over 1 million people to something like 6,000 people. And some of them escaped to somewhere. They had an estate in the south of what's today France, and most of them obviously perished. And after that was the Dark Age. That's what I think is coming. And I wrote an article, which is arguably my most important article, called "When Gold Backwardation Becomes Permanent." That there will be a point at which the people who own the gold are not willing to, trade it for dollars, not even temporarily in the form of a forward sale or anything else. They're just going to just hold it. Gold market seizes up, and as a consequence of that, the dollar loses all of its value in probably a few weeks. People will call it hyperinflation. They'll say the government printed too much money. Nothing to do with that. It has to do with the gold market. And that, should that come to pass, that will be horrific.
So for that sort of event, the only way to truly prepare for that potential outcome would be to have a decent allocation to gold and silver. People are good. I can already see people in the comments right now. You're interviewing somebody who has a company involved in silver. The sponsor of my channel is a gold and silver bullion dealer. So you always get these things thrown around in the comments. They're just trying to sell their own product. But I mean, ultimately, in that sort of scenario, what else is there? I guess aside from potentially owning real estate that's free and clear of any mortgage or any sort of debt obligation attached to it, would that be another way to kind of actually just owning an actual hard asset like that?
I mean, that scenario is not about assets, frankly. It's about survival. And I think, we always use the term zombie apocalypse or Mad Max, but I think that's what the cities will be. It will be gangs, killing, and I don't care what you own or who you are, you can't be in that environment. The closest analogy that I can really come to this, so I studied under this Hungarian professor who escaped Hungary in 1956, one step ahead of the Soviet, takeover. And there was somebody else who studied alongside me who was an 8-year-old kid. So the professor was, what he would have been 16 or 17 or something at the time of the Soviet takeover of Hungary. This guy was like, 7 or 8. And in both cases, somebody possessed gold. In the case of the person who was 7 or 8 at the time, his dad had a gold watch. And, at the moment where they were escaping, I guess the Soviets already had armed guards, guard stations, all along the border, let's say with Austria, but probably all the other borders too. And so the family was headed towards Austria and, ran into, like machine gun guards with the bandoliers of bullets on the chest and everything, or whatever it looked like in those days. And, the father took off his gold watch and offered it to the, sergeant or captain or whatever it was. And, the guy looked at it, could tell from its weight, and, it's looked at it, was real gold. And he said, the border's that way, run. He said, my men and I are going to go patrol that way. And we come back in 15 minutes. If you're here, we'll shoot you. Run. And so they escaped to Austria, and then from there to the UK, and eventually to Canada. So gold may buy you passage. But here's the sobering thing. I saw a museum exhibit, and it kills me. I can't remember if I saw this in London or in Zurich. But it was a museum exhibit of gold mostly coins, but solid gold stuff that dated to the time of the collapse of Rome, that dated to 476 AD. And these were very sizable hoards that were dug up in the post-war building boom, the 1960s and 1970s. They're building bigger buildings. They have to excavate deeper foundations, and they found, I don't know, there was a dozen or 2 dozen of these hoards that they found. And what's sobering is, right, so these are pretty big hoards. I mean, the smallest was like hundreds of ounces, and some of them were thousands of ounces. That was a fortune then, just as it is today. Most people can't command 2,000 ounces of gold today, and the same in those days, obviously. Um, so these were people that were really wealthy, and yet that wealth didn't avail them. And there's no record. We don't know, what happened to those people. Did they take a whole bunch of gold, get in a wagon, and have the horses pulled them to safety somewhere, or do they escape with their lives and not have a chance to really access any of their gold, or do they get killed? They were trying to escape their villa and they got stabbed by a sword in the street, 10 feet from their front door. We don't know that. I can imagine, supposing that a few of them did manage to escape to some country estate, 500 miles away in France or whatever, that whoever escaped would have been, talking to their family about, we have a villa back in Rome, and there's, in the cellar, there's, hidden gold, and we have to go back and get it one day. But of course, that was the beginning of the Dark Ages. The road wasn't safe. I mean, if you travel on the road, you get killed. And so eventually they would just basically pass that on to their kids, that, Pappy's gold, treasure in the villa in Rome. And they would tell their kids, and it's Grandpappy's gold. And within 3 generations it becomes a myth, that there's gold somewhere, and 10 generations after that it's like lost and forgotten. And by 1970, when they excavated the foundation for the building, nobody had any idea, that there was some heir to it or whatever. It's long gone and long lost. So having that gold, it's certainly better to have the gold than not, but in that scenario the gold may not avail you. You may still get stabbed, 10 feet from your front door, or you might escape with some of it, and most of it is actually stuck wherever you hit it. And, as soon as you think that through all the way, you think, what, I want to try to avert that disaster rather than plan the perfect survival plan for them. You get some bunker up in the mountain somewhere, and you have some, barrels of water, and you have barrels of dried food and all that. And what do you do when all that stuff runs out and you have to poke your head above ground? And let's assume that you can live long enough, and I've thought this through, let's assume you live long enough that all the Mad Max gangs have largely burnt themselves out, right? So after they prey on everybody that has food, they turn on each other. A year later, there's probably not too much of that going on, and people have to settle in and somehow, hunt for food, fish for food, or farm for food, or hunter gatherer, or whatever. And the population is going to be pretty sparse at that point. So you poke your head out, and it's like, okay, I survived all that. Now what? Now you are suddenly in a survivalist mode, hoping to, within 10 or 15 years, become a farmer by, by clearing land and, planting and all that. And so your best case scenario is a 17th century agrarian, lifestyle. That was a tough world. And, I don't know how old you are, but I know I'm way past my shelf life. Life expectancy in that world was 35 to 40, even assuming you didn't get killed in war, and all the other things that were going on, even assuming it was all peaceful. There's no doctors, there's no penicillin. If you break your foot, you could end up dying of starvation because you can't produce food anymore. Like, it's pretty rough. So, do you want to plan the perfect survival scenario and put all of your resources? Life's pretty good today, right? Do you want to put all of your resources that you have today and live this mean Spartan existence for who knows how many more years just to have the perfect survival scenario post-apocalypse? Or do you want to try to avert it? And I said, you know what? I want to try to avert it. I don't expect I'm going to live through that scenario. I wouldn't necessarily want to be alive after that scenario. And I wouldn't necessarily be able to stay alive, after that scenario anyway. Anyway, it's pretty bleak stuff. I didn't necessarily want to go down this dark, dank hellhole.
Well, we do that a lot on this show, so you're in good company. That's a regular theme here. Um, Tell us about monetary metals. Tell us about this new silver bond you've got. You touched on it earlier. I'd love to hear about that, and just an overview of the company and what it is you do as well.
As I said, I decided I wanted to try to avert this disaster. And the disaster really is because we have this irredeemable currency. People call it a fiat currency, which is true. It's imposed by force. The government dictates it, and that's why we use it. Um, but I call it irredeemable because economically, that's the salient point. That it's a promise to pay that says right in the fine print that it will never pay. So you just get a government credit, and when we pay debts using government credits, which means we pay a debt using an IOU, and so the debt is never extinguished. It's just merely shifted from one party to another. And so the debt grows exponentially. It grows by at least the accrued interest, and actually a lot more than that, because you have to, if you're managing the system, if you're the Fed, you have to try to somehow manage it so that the marginal debtor can get his hands on enough dollars to service his debt. Otherwise, the defaults begin, and which possibly is what the Fed is fighting right now. So, debt goes up exponentially. The interest rate's unstable, and certainly the last 40 years it's fallen. And the combination of the two is it's a machine that is consuming and destroying capital. Right? So everywhere you look, like if you look at physical buildings, they all show signs of rot. There's unpainted steel that's rusting. There's unpainted wood that's dry rotting. There's all this neglect going on. Oh, there's one elevator that just has an out of order sign, never seems to get fixed. Just everything is just rotting. And that can go on for a long time. There's the old Ernest Hemingway quote, "How did you go bankrupt?" At first slowly and then all at once. So, we're just neglecting, things. And at the same time, we're also fueling rampant speculation. And speculation is, when asset prices going up and up and up, not because of any merits, but just because of monetary policy, then that's a machine for the conversion of one party's wealth into another party's income. So suppose you buy a Bitcoin and you're lucky enough to get in for $1,000, and then the price goes up to $10,000 and you sell it. Well, you have not, you get your $1,000 in capital back. You have a $9,000 profit, but your profit came out of the next guy's wealth. That was his life savings, and you spend it, or you spend some of it happily. He would never spend his life savings. He doesn't want to be the prodigal son. But an endless bull market of that sort, creates a prodigal society where everyone is spending someone else's wealth through the magic mechanism of asset prices that just keep rising and rising and rising. So we have a million and one ways. We take real capital, we piss it down the welfare drain, but we replace it with paper capital in the form of bonds, and the bonds go up. So instead of the unhappy thing of trying to loot the producers by making them pay more taxes, where they're unwilling and they fight it every step of the way, instead, they willingly give their money to get this piece of paper called a bond that not only does it pay a coupon, but the bond value is always going up, in a falling interest rate environment. As we were talking before the call, TLT, which is the fund that contains basically treasury bonds, is going up the last couple of weeks. And obviously it was going up and up and up from 1981, through present, or whenever they created that ETF. So, we have a variety of mechanisms, monetary mechanisms, to incentivize the consumption or outright destruction of capital. And, the question is, okay, but that would mean what happens when you get to the end, when the capital is consumed? And so, look at Venezuela as a microcosm. All the socialists think that under Chavez, it was an economic miracle. And they're pissed off only at Maduro because Maduro doesn't seem to be smart enough to be able to continue the Chavez miracle. Well, the Chavez miracle was that there was still capital left, to consume. So as long as, imagine a frontier farmer that has a bin with corn for for seeds for next year. And then, you bust out the seed corn and you have a big party. It's not an economic miracle. It's not genius. you're just feasting on something that isn't really food. And if you do that, as long as it lasts, it can seem like great fun. And then when it's over, okay, it's over. And then let's say it's springtime and it's over. Okay, during spring, no one's going to starve. The starvation sets in the following November when you didn't plant a crop, when you could have because all the seeds were gone. And so next winter, you don't have anything to eat. And so that's what the system is doing. And when it gets to the end, then you can't produce any, the capital required to produce energy is a capital intensive business. The capital required to produce and distribute food, very capital intensive. When that rots away, when that sort of collapses like a bridge, then, there's going to be real human misery. So it's the monetary system. And so my thought was, okay, we need to replace the irredeemable dollar with gold. And gold doesn't allow any of these things. Gold doesn't create these perverse incentives. A perverse incentive incentivizes perverse behaviors. Perverse behaviors get perverse outcomes. Gold doesn't do that. So if you're using gold, then not only is it an honest system, not only are the savers not being ripped off by monetary policy. If you read Milton Friedman, I just have to go on my little Milton Friedman rant. So everyone thinks he's a free market guy. Google Milton Friedman daylight savings. There's a quote from this guy. We're talking about, what I should do is I should actually read it.
Sure.
The argument for a flexible exchange rate is, strange to say, very nearly identical with the argument for daylight savings time. Isn't it absurd to change the clock in summer when exactly the same result can be achieved by having each individual change his habits? All that is required is that everyone decide to come in his office an hour earlier, have lunch an hour earlier, etc. But obviously, it is much simpler to change the clock that guides all than to have each individual separately change his pattern of reaction to the clock, even though all want to do so. This is a free market guy, right? Saying, oh yeah, what a pain in the ass it would be for everybody to have to make their own individual decisions in the free market. Anyways, the situation is exactly the same in the exchange market. It is far simpler to allow one price to change, namely the price of foreign exchange, than to rely upon changes in the multitude of prices that together constitute the internal price structure. And this is in a context of wages, that there's times when wages have to adjust downward, and Friedman is saying that's really hard to do. Much easier to just have the money adjust downward, which means the savings of everybody that has worked hard their whole life and has savings is to go down, because that's much easier, much more efficient, according to Milton Friedman, than having wages get renegotiated. Well, if you're 70 years old and you've worked your whole life to save something, and Milton Friedman wants your savings to go down by 3%, just to make it easier to renegotiate some union contracts or whatever he was thinking, that's monstrously unfair. But more importantly is the consumption of capital that's fueled and incentivized by this. So that was my thought. That was my obsession. Is, okay, how do we bring back gold? And I realized very early on in this that a lot of really smart economists, Hayek and Mises, just to name two, have been talking about, look, y'all need to return to gold. But after 1933, it wasn't the gold standard anymore. It was a bastardized, bullshit thing. And some really smart people were saying this is what you need to do, but they weren't successful in getting society to change course. And I don't think that was any demerit or any fault of theirs. I just think, obviously, the socialist tide was sweeping, and anybody that was a free market guy was just going to get overrun by that tide anyway. But then secondly, even people who take it seriously, okay, gold, yeah, I get that. What are you supposed to do with that? Well, you're supposed to buy gold, I guess. And then a funny thing happens along the way. You buy the gold, and now you're cheering for the gold price to go up. So that what? So you can sell it for more of the dollars you just said were shit a minute ago, and you want more of them. And Brent Johnson, I don't know if you know him.
I've interviewed him before.
On Twitter, kind of teases, the gold bugs, but in a way that I think is apropos, which is, okay, you say you never want to sell. What's the point of this thing? And which is really kind of getting to the root of what's the point of an asset without a yield, right? Is okay, you bought it, and now what? Now you're waiting for the price to go up, and all the gold, dealers are always talking about why the price is going to go up, which is why, I've pissed off some of them by sometimes saying the price isn't. Now I'm saying it is going to go up, but there's been plenty of times when I'm saying it's not going to go up, and anyway, so round and round it goes. But economically, it's useless. Okay, you buy the gold, it goes up, you sell it to the next guy, you're out. Now you have more dollars, you can consume more. Okay, great. Economically, that didn't do anything other than consume a little bit of someone else's savings. In the same way that when Bitcoin goes up, or real estate, or whiskey, or wine, or 1957 Ferrari Testarossas, whatever. Um, but the key is the yield, and it's the key for several reasons. Number one, now it's not about selling the gold. Now it's about, saving in it, genuine saving. There's no such thing as a yield without production, without financing a productive enterprise. So somebody is making something that society values or consumers want to pay for, and that needs finance. And if you finance it, then they pay interest, for the privilege of getting that finance. So you're weaning the debtors off of the dollar and into gold, which is very, very important. Um, and obviously, you're giving savers the incentive, and you're pulling gold into the market. Without interest, all the gold disappears. It's like a black hole. No matter how much the miners produce, it can never, ever, ever fill the insatiable demand of that black hole, which is all the private hoards. Every ounce of gold that's mined, without any apparent limit so far, after 5,000 years of accumulation, every ounce that's mined, we produce something like 3,000 tons a year of gold. It all just disappears. Um, and if you want to draw the gold into the market, then you have to, offer an interest rate on it. And so I thought about that quote from John Pierpont Morgan, the man who, in one of the crises, it might have been 1907 or 1890, I forget which crisis it was. Anyways, someone allegedly went to him, Mr. Morgan, there's a crisis in New York. There's a shortage of gold. What are we going to do? And he said, raise the interest rate. 4%, he said, will draw it from the continent. And in those days, it was like a steamship. It was risky. It was expensive. It was slow. It wasn't like, you give it to Brinks and they put it in the belly of a passenger aircraft. And then 6 hours later, it's on the other side of the pond. He said 5% will pull it down off the moon. So what he was saying, which is something that would have been well understood at the time, the interest rate regulates how much gold comes to market. The rate's too low, the gold all disappears. There's a shortage. You raise the interest rate, there's no shortage anymore. So you got to be willing to pay a bit more. So I thought about that, and I thought about that quote from Keynes that most gold people would know, because it starts out saying there's no surer way to overthrow the capitalist order, which is really civilization, um, than by debauching the money. And he goes on and on and on, impoverishing most people, arbitrarily enriching a few. Most people assume he's talking about inflation. But at the end, he says, it engages all the hidden forces of economics, which today we call incentives, in favor of destruction, and not one man in a million can diagnose how their world is being destroyed. And I thought, okay, if he meant inflation, he was an idiot. Because everyone talks about, like today, everyone talks about inflation every day. I'm just old enough to remember the late 1970s. It was on the nightly news 5 days a week. Inflation, inflation, inflation. They had the misery index, which was inflation plus unemployment. So I don't think Keynes was an idiot. I think he was actually very smart. He's evil, but genius. And I think what he was talking about was drive the interest rate to zero, which he talks about quite explicitly in a number of other places. And then therefore you drive asset prices to infinity. And that was actually his plan to overthrow the capitalist order and get the bourgeois to, some of them are arbitrarily enriched. The fellow bourgeois resent them. The whole communist thing hinged on drive asset prices to infinity. And with the capital that's being destroyed, eventually the whole thing collapses, and everyone is angry and everyone is shooting everybody else. It's like, wow, this person was a psychopath, but brilliant, in a way. And I kept thinking about that, and I was like, okay, well, what's the antidote? An incentive or hidden forces of economics, not in favor of destroying civilization, but in favor of saving it from Keynes, who was setting out to destroy it, thinking about Friedman and the antidote to that, thinking about J.P. Morgan. It all came together as you got to offer interest on gold to put it to use. And if you do that, the gold will come. That was the business thesis. And the gold will come into the market and start to displace the dollar as a finance thing, was the economic thesis. And, so far it's working. So there's a why behind this. And the why is, I don't know how much time we have. If you asked me in 2012, I thought we had 5 to 7 years. So my prediction about the future turned out to be really hard. And obviously we had a lot more time than that. I don't know how much more time we have, but I feel like I've got to make a go at trying to avert this disaster that's coming and draw the gold back into the market and create a bottom-up entrepreneurial free market monetary alternative to the dollar and its destructiveness. And we do it by leasing it. So there are companies that have gold as inventory, and they need to finance that. So we do that, and we do that by lending it to companies that have a gold income or silver income, as the case at Bunker Hill. And so, this is a mine. They produce silver, they produce lead and zinc as well. They need to borrow some money to, build and refurbish a plant to process all the ore that comes out and make a concentrate, which they sell. And so we're giving them a 1 million ounce silver loan. And we're paying 12%, to investors who participate in that. But the whole point of this is we start, it's kind of like we have a corpse of the monetary system. And, so if you kill somebody, all of the atoms, all the molecules that, that person is composed of are still there, at least initially. I mean, months later, different story, but everything's still there. But you don't have internal motion anymore. All the chemical reactions have stopped. Obviously, the heart is not pumping blood and the brain isn't, synapses aren't firing. And, philosophers have obsessed since forever, and doctors, is there any way to restart life once life has been extinguished? Nobody's found a good answer to that. Medicine ends, when life ends, right? So today we have kind of the corpse of the gold standard. All of the gold atoms that existed in 1933 are still here. In fact, a heck of a lot more. The miners have produced an awful lot of gold in the last, 90 years, 89 years. 91 years, excuse me, I'm doing my math wrong. But you don't get any motion. So how do you restart it? And if you can restart it and really get it to scale, then you can avert that, Keynesian destruction. You can avert the Armageddon that I talk about in my gold backwardation paper. You can get the monetary system and therefore civilization moving in a better direction. That's what this is about.
Great. Well, I'll put a link in the description below to the Monetary Metals website for people who want to check that out, as well as social media. Keith, it's always a blast talking with you. I always learn so much. I know the audience did as well during this conversation. So thank you so much for coming on.
Thanks for having me.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver, Gold, Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.